Ayubowan, ladies and gentlemen. Thank you for joining National Development Bank PLC's quarterly investor webinar. Today's investor webinar will be to discuss the financial performance for the first half ended 30th June 2023. The webinar will follow the same format like our prior webinars, where the bank director and chief executive officer, Mr. Dimantha Seneliratne, will take you through a prepared presentation. At the end of that, he will open the forum for questions and answers. All participants are kindly requested to stay on mute through the presentation and the Q&A. You can please use the chat option to post questions. This is a recorded session, at the end of which we will release a playback video. So on those notes, see you. Thank you.
Okay. Good morning to those joining Sri Lanka and also some of those in the Far East. Good afternoon. Welcome to NDB's investor webinar, where we are sharing our first quarter results. With me, I have my part of my leadership team joining today as panelists, so that they will also chip in when there's a need to answer your queries. Just to give a background of the operating environment, we all know it's a very turbulent time that we have been going through over the last 1 year and even the 6 months or so. Things are getting better, but still a lot of uncertainties, a lot of changes that we saw. So that's the background that we operated. If I may elaborate more on the economic conditions and also how the impact on the banking sector, etc. Of course, we saw the monetary policy being relaxed. We saw 450 basis point reduction in the policy rates since 1st of June. Of course, earlier the tightening measures, steep increases in the monetary policy and all have helped to reduce the inflation. So every month during this year, we saw steep reduction in the inflation numbers, and as of July, it has come to a mid-single-digit figure of 6.3, which is also in line with the central bank's expectation, government expectation to maintain a mid-single-digit kind of inflation. So it's good to see that improvement. It's also with the lag effect, how the policy measures taken by the government has resulted in helping curtailing the inflation side. We also saw improvement in domestic supply conditions, and with the exchange stabilizing, we saw a certain relaxation of restriction that was imposed on the imports, and also the gradual enhancement in business and investor sentiments, which was also shown in some of the surveys conducted. But as a bank, because banks are involved in economic activities, we saw activities picking up during the first half. In terms of external sector performance, of course, we have been resilient amidst all the challenges. We saw a good improvement in worker remittances, which is a very good note to see. Compared to last year, full figure of $3.7 billion that we received. Up to June, we received $2.8 billion. And one good thing is the informal market is virtually now not in existence, which is a good point. And we saw even in July, the worker remittances has crossed about $530 million. So that's a good sign. We also saw tourism side picking up, tourist arrivals crossing 820,000 as at last week. For the year, compared to the whole of last year's 719,000. Gross official reserves also have improved to 3.8 billion. And exchange rate also stabilizing to some extent. We saw exchange rate from high 360 figure in the end of last year, improving to current level of 322 range. Then country also saw some inflow of World Bank funds, and IMF first tranche was also released, and We're looking forward to the release of second tranche in September. The ADB, there was a $350 million that was received. So all these inflows and the external measures that were taken helped us to improve on the external sector performance. The other thing is on the policy rates. We saw policy rate reduction of 4.5% of 150 basis point since 1st June 2020. We saw the first reduction in June from 15.5 to 13%, 2.5% reduction, and in July there was another 2% reduction. So that the current SDFR stands at 11% and SLFR is at 12%. And more importantly, recently, the statutory reserve requirement was also reduced from 4% to 2%, effectively improving the liquidity in the market, again signaling some opportunities to grow and improve on the liquidity. Market rates, as a result, substantially reduced from very high levels in what we saw in 2022, which was 60, 1 year T-bills were going around almost touching 30%, 29.7. Now has come down to 13.94. We saw even 3 months rates also steeply climbing down. And the AWPLR, which was around 28% in 2022, end of 2022, reducing to currently about 18.2%. And it's such a reducing trend that we have seen. AWDR also at 14.67. The other key important announcement was the domestic debt structuring. That actually helped to reduce the risk premia assigned to the interest rates of the treasury bills and bond side, and also the uncertainties that was revolving around the banking sector were all clarified through that announcement. So that also helped to reduce the interest rates. With regard to the banking sector, very broadly, we saw the sector-wide assets declining in the first half. Industry-wide, the entire industry had seen a decline in the total assets. And also the loans and receivables also had a negative growth. Purely one was the exchange impact from 360 to the 320 level. But other reason was consciously because of the high environment, high interest environment, and the credit concerns, banks have been reluctant to grow. And there was a lesser demand also from the customers because of the low growth or the low GDP situation. So instead of a loan growth, all those assets have been sector-wise. We saw increase in investments, basically shifting the funds to investment in the loan book, reduced and then moved on to investment in the government bonds and bills. The other thing is the credit quality continued to deteriorate, and the industry average was around 13.5. The entire industry saw the decline in the credit quality. And then on the deposit side, we saw a moderate growth of deposits. Naturally, the inflation hitting so high numbers, naturally people's ability to use their savings or save was impacted, resulting a lower growth in deposits. Of course, the steep increases in personal taxes also contributed to that situation. So other thing is the CASA deposits, substantial decline. The entire industry saw substantial decline in CASA numbers, mainly because of the high interest parity between the fixed deposit cost. Even a 3 months deposit was going at a high rate compared to a low savings rate. So there was a tendency for consumers to move on to even to get a short-term advantage in deposit rate. So that also had an industry-wide impact on the CASA. Then liquidity wise, there was an improvement in the liquidity market. So liquidity again because of lack of demand, and also one of the biggest borrowers, the government sector borrowings are also curtailed. So both in local currency and foreign currency, the liquidity situation tremendously improved. Entire banking sector, I'm sure, on the foreign currency side are very highly liquid, and that is a trend that we saw. And the other thing that we are awaiting now is, now that the domestic debt structuring is over, the outcome of the sovereign bonds, the discussions that are ongoing, because local banks also have a substantial stake in ISB. That is the one that we are being waiting for. We saw all the SLDBs, Sri Lanka Development Bonds, were settled. Outstanding SLDBs were settled during earlier this week. Total settlement by the central bank was about $788 million that was settled, and that funds were injected in rupees. So that we saw, and awaiting the next step, which is the ISB structuring side. All the banks have made up sufficient provisions for potential haircut that have been indicated in the domestic debt structuring paper, and looking forward to that. So that's a little bit of the operating environment that we operated in the first half. And I move on to the financial performance. It's a transformative journey that we have been going through. Initially, we were going at a pace to grow the balance sheet, but last 2 years with the COVID impact, the huge exchange situation and all, we have transformed our strategies to a more balance sheet focused growth. If you look at the financial performance for the first half, compared to last year, we had gross income year-on-year increase of 50%, going up to 66.7 billion rupees. Profit before tax, we had 55% year-on-year growth to 4.2 billion, and profit after tax to 2.3 billion, which is a 37% year-on-year growth. Of course, the tax rates were revised during this year. That's roughly about 8.5% increase in the tax rate. So that also resulted in profit after tax increase is lower than the increase that we saw in the profit before tax. In terms of balance sheet, the total assets of the bank recorded a 5% decline to 793 billion rupees. This is mainly due to the exchange impact from height, because about roughly 25% of our book is in dollars or the foreign currency. So that would have an impact when the exchange reduced, the rupee to dollar exchange reduced. That is one reason, but also we saw a loan book on the rupee side also shrinking, because the lesser appetite for credit, and even the bank also didn't want to take much exposure in an uncertain environment. There's a demand for credit as well. So all that contributed for a 5% reduction in the balance sheet. Loans and advances, that's where we saw 14% negative growth to 470 billion. Whereas on the deposits, we saw a 7% decline to 628. Deposits, of course, the main impact is because of the exchange impact, where the dollar-denominated deposits were converted at a lower rupee rate. With regard to KPIs, net interest margin at 3.7%. Now, relative to industry, this is slightly lower. There are reasons as well, but that's something that we are working on. Return on equity has improved to 7.2 from what it was last year. Cost-income ratio, I would say one of the better cost-income ratios, 35% compared to the industry. And then on the impaired loans, stage 3 ratio, it has gone up to 9.2, slightly above the industry, but we are expecting that to improve by the end of the year. In terms of capital ratios, Tier 1 has improved to 11.04%. There's a separate slide on capital ratios over the 5 years, which when it comes to that, I will elaborate more. And total capital adequacy ratio has improved to 14.78%. Moving on to the financial performance, the income statement, we had gross income growing by 50%, as I mentioned, from 44 billion to 66 billion. That came out mainly from interest income growth of 70%, from the 26 billion to 37 billion. However, interest expenses were quite steep. So from 22 billion to 48 billion, the interest expenses, which was about 117% growth, mainly because of the high interest rates that were prevailing. Now, this would get corrected going forward with the rate revisions that we saw in June. However, the first half, naturally, because of the high rates, the deposits have been repriced. So the entire industry saw a similar situation. If you look at the net interest income, in NDB's case, it's a small increase from 14.9 billion up to 15 billion. A small increase, mainly because of the repricing of the deposits at a high rate. But that would get corrected as we see every month a substantial deposit base is getting repriced at a low rate. So this should get improved in the NIM. With regard to the non-fund based income, that's where bank has done quite well when you compare with the industry. Also, net fee and income, commission income, we had 19% growth in a challenging period where the demand for imports also became less with the exchange going up from 3 billion to 3.657 billion, about 589 million growth for 6 months, which is a good one. Then with regard to the non-fund based income, it has come down to a negative 144 from 4.3. This is mainly due to the revaluations of the, basically the exchange rate impact, revaluation of the capital. And with regard to total non-fund income, it has come down from 7.3 to 3.5. Though the net fee and commission income had a good growth, because of the exchange impact, there was a negative contribution. So all in all, the operating income from 22 billion to 18 billion, there was a 17% reduction. In terms of impairment, again, it's another key element, a substantial figure in our P&L. Impairment charges have come down substantially from 13.9 billion in last year, first half, to this year, 7.7 billion. So total about 6 billion. Of course, we have been improving on our loan and advances related impairment. However, bank had certain impairment releases with regard to the investment in ISP, mainly due to the exchange improvement, exchange rate that rupee side improved, so that the quantum that was passed in LKR reduced. So actually that benefit, most of that benefit actually was used to build up the impairments on loans and advances. In terms of KPIs, with regard to the asset quality, the impaired loans ratio has gone up to 9.2 from 6.2. This is mainly due to a couple of large ones, which we are comfortable that we should be able to get them out by the year end. And then on the impairment cover, from 37%, it has come down to 33 point, almost 34%. Again, because of a movement of few large exposures where we are very well secured, So that's where the impairment cover is less. Total impairment cover is now from 5.8, it has improved to 7.84. Net operating income that has been up by 27% to 10.7 billion. We are moving on to the expenses side. So that's where the total operating expenses, if you look at, it has grown only by 13%, 5.7 billion to 6.5. Now this is where NDB's focus on the digital initiatives have really paved the way. Despite substantial increases in the cost side, substantial inflation, all that, we have curtailed our expenses and managed well. So all in all, the increase in the total operating expenses was only 13%. Is one of the best among the industry when you review the comparator numbers that we saw. And the composition of these expenses are given below in the pie chart. Financial performance in terms of taxes and profitability. So there again, profit for the period, first half, profit before tax was 4.1 billion, a 55% increase. However, tax on financial services, 43% increase from 841 million to 1.2 billion. And then income tax expenses, substantial increase from 132 million to 613. So all in all, the profit after tax was 2.3 billion, a 37% increase from last year. And the effective tax rate has increased from 36% last year to 44%. So that's about 8% increase. The breakup is also given here, the movement in the regulatory tax rates. FS VAT remains same at 18%. However, the income tax was increased from 24% to 30%, a 6% increase there. And SSCL, it was introduced in this year, which was 2.5%. In terms of balance sheet, as I mentioned, the total assets reduced by 5%, and the breakup is given here. Mainly the gross loans have come down by 70 billion, 580 to 510. On the deposit side, this is reflected, and also there's a reduction, substantial reduction in borrowings from 81 billion to 28. Almost all our foreign currency borrowings have been settled. And total liquidity side, we saw a 6% improvement from 64 billion to 67 is basically the retained profits that for the first half. And I must say the first half financials have been audited by our external auditors. We did an interim audit. So that's also like to share that these financials have been audited by the external auditors. In terms of currency-wise composition of loan, there have been queries in the past, so we thought that we should present it. It's 22% in foreign currency versus 78% in local currency. And in terms of deposits, 27% of our deposit base is in foreign currency and 73% in local currency. So foreign currency exposure is relatively high, around 25% of the book. That's something that we want to share with our investors. So the balance sheet movement was largely in line with the industry trends, and total reduction in asset reduction is also, as I mentioned, due to the rupee depreciation and also the lack of demand for assets. So all in line with the industry. There's nothing here where I think we have been basically moving along with what the industry has seen. Investor ratios, of course, the first half, we closed the share price at 50 rupees. It's improved from 32 in December. It has improved since then substantially to, it crossed around 84 rupees. I think yesterday it was hovering around 79. Earnings per shares has also improved to 11.8, and ROE has improved from 4.75 to 7.2%. ROA also pre-tax from 0.26% to 1 rupee. So these are some of the improvement that we have seen compared to last year. Of course, last year was a very challenging year that we have seen, and we see the recovery going, and that recovery further going to get improved as we move along with the interest rates and all getting stabilized, getting reduced. Capital and liquidity position. Again, we saw quite substantial improvement here. Tier 1 ratio from 9.34 to 11%. And then total capital ratio also 13.35 to 14.7, about over 100 basis point improvement. Statutory liquid asset ratio, whilst the minimum was 20, bank is quite liquid with 34%. One is the adequate deposits that we have, and also the lack of demand for the credit. And also in the foreign currency side, also there's enough liquidity at the moment. So all that have been reflected in very high liquidity asset ratio. Even the total liquidity coverage ratios are very much above the regulatory requirement, as you can see from the below right hand graphs. With regard to capital adequacy ratio, the left the graph, I just want to elaborate more on this. That has improved. You would see that 2021, our capital ratio moved up to 15.42. And also the that's a total capital ratio, and also the tier 1 improved to 10%. This was the time that we raised fresh capital through the rights issue, and also that's where No Fund also came in as an anchor investor. However, in 2022, you may recall, with the steep depreciation of rupee from 200 odd to a very high about 300, the entire dollar book got highly inflated. Plus, we also had substantial tax impact. You may recall about 2 billion in terms of super gain tax. All that actually impacted on our capital ratio, so it came down to 9.34, and also the total capital came down to 13.35. So since then, we have been improving to 10%. And now 11% the tier 1 ratio, and even the tier 2 has improved now to 14.77, partly due to the reduction in asset book, and also other thing is the inbuilt profit retention that we have been doing. So in terms of dividend, the cash dividend was lower. Now this is to regroup and capture the capital adequacy ratio that was deteriorated due to the 2022 shocks that we had. Moving on to the way forward, of course, we have been responsive and agile, and that's the advantage. NDB being a mid-sized bank, our agility is one of the key areas. So we have recovered quite soon, and now it's how we move forward. So there are a couple of strategic priorities. We look at comparatively, our net interest margins are low, so that's something that we are focusing really hard on going forward, especially in a low interest environment. Managing the NIMs, net interest margins, would be a key focus area. Then in terms of fee-based income, we have been doing above average. Our fee-based income, despite all these challenges, have been static and growing. You saw that in the previous slides, and we'll be focusing on that to enhance the revenue mix coming from the fee-based income in a low rate interest regime. Then the cost rationalization, again, would have seen our cost increase, overall cost increase for first half was only 13% in a very high inflation situation. And that would help to preserve profitability and enhance the shareholder returns. Then another key area is the preserving the asset quality. The asset quality that got deteriorated is gradually being restored. We have already set up the loan remedial management unit to support these customers who are in distress situation, plus enhance the recovery strategies. All that has seen quite a good improvement in our recovery front, and month on month we see quite a good improvement. And also, since we are not grown the asset book, what you see is naturally as a ratio, the impacted loan as a percentage of total assets would go up when you are not growing the balance sheet. So in an area where now that interest rates are coming to a situation which is acceptable, there is demand for credit that is picking up. So we will be cautious in the loan book growth, but whatever the new loans that we'll be booking, it would be risk efficient in terms of lending. We have used the RORAC base to ensure that certain minimum RORAC thresholds are met, and also the transactional accounts that are being coming in, that should also help to manage our NIM. We would also look at supporting our customers maintain their resilience. We are thankful to all the customers who have been banking with us, also customers who have been onboarded recently or through all our channels, including the digital channels, for banking with us. And we have been helping as a true local commercial bank, fully supporting their challenges whenever they went through. So that has been one of the key elements that NDB has been always using to support our customers. Even during the height of the financial crisis, during the height of the foreign currency crisis, this is where we scored. And those good relationships that we have maintained, the good things that we have supported in the challenging times, actually are now repaying back by these faithful customers. We will continue to manage our liquidity position strongly, highly liquid, but that would be the case going forward as well. And we will be preserving the capital in current conditions by basically not growing at a higher pace, maybe managing the growth of the balance sheet. But going forward, it would be more on managing the margins from a lower balance sheet, but how you basically optimize the efficiencies of using that balance sheet to get the best in terms of profitability for our shareholders. So preserving the capital is one of the key elements. We have also announced Tier 2 Basel III compliant listed, rated, unsecured, subordinated debenture issue going up to 10 billion. That could be raised during this year. We were to raise up to 6 billion. That was announced to the market. However, with that was to go at a bit of high rates, but we saw the interest rates coming down steeply, so we withheld that because our capital ratios were on the other side was also improving. So now that we have withheld, most likely we'll have some announcement on how we are going to raise this in the remaining 6 months. That would naturally will come at a much lower rate. That would also help saving a substantial interest element compared to what we were planning to raise earlier. So that would also have a substantial interest rate reduction going forward in terms of savings. And idea is to provide best possible return to shareholders and also support all our stakeholders, our staff, everybody who's contributing in these challenging market conditions. And in doing so, digital drive would continue to be a priority. We have completed our core banking upgrade. Now successfully, it is in operation. We have been empowering women, the women's market, so that would continue. And also our ESG related initiatives, those would continue as we move forward. So that's about the way forward. And that basically comes to an end with the prepared presentation. And we are quite happy to take on the questions and answer them along with my team here. So you can raise the questions, and what I'll do is I will read the question, and either me or some of my team will provide you the answers. So the first question is about what happened to your debenture issuance. We read that which withdrew its rating as the issuance has been cancelled. With reduction in SRR, how much more will interest rates fall? Okay, that's the second question. So I'll handle the first question. That's about debenture issuance. As I mentioned, we didn't want to raise at the high rates that we have been looking at earlier. There was a book building process as well. However, with the steep reduction in rates, improvement in the liquidity, we thought that we should defer this raising. So that's why we withdrew and we announced the market, and then Fitch also withdrew their rating because we cancelled the debenture issuance. But since we have the approvals to and announcement to go for a debenture raising during second half of the year, we would be making the announcement once it comes to the right price. We'll be raising again to improve on a total capital ratio. With regard to statutory reserve requirement, of course, about 200 billion liquidity was injected. The question is how much more will interest rates fall? Probably in Iran, my head of treasury, he has the crystal ball to give some indication with qualifications, of course.
Actually, currently we see a big difference between the policy rates, current policy rates at 11% and 12% against the treasury bill rates. That is mainly to compare the 3 months rate. So what we will see is right now, like in yesterday's auction, what we saw, that these rates will converge now. So the first thing what will happen is that your treasury bill, we will see your treasury bill rates coming down and more towards closer towards the policy rates. So after that, probably central bank might take a policy decision once again, whether they want to reduce rates further in the coming months. So the first thing is that the converging of the T-bill yields closer to the policy rates.
Thanks, Islam. Another question is, since you are looking to increase your loan book, would you consider factoring state receivables? For example, will discount receivables owed by CEB? Now, by the way, we don't have that much of exposure to CEB, but we have seen with the utility prices going up, the cash flows of these state entities who have been borrowing from us improving, and some of those payments that were overdue has been settled. So that's a good improvement. In terms of factoring state receivables, we need to find out who is willing to take that state risk and then do the factoring. If that is the case, we would be looking at it, but right now I think things are improving. There's a question on how much impairment take on foreign currency bonds in this quarter. So I think with the exchange rate improvement and etc., we are in line with the required foreign currency ISP specific impairment numbers. So there's not a major change there, because the provision that we made in the beginning of the year was also sufficient to cover the ISP provisions, which is in line with the industry. That's a question on with the current rate volatility, what is the strategy of the bank? I think I briefed that we are not keen on growing the balance sheet at the moment, but we will ensure that the current balance sheet would give the maximum returns in terms of improving on the margins and also improving on our CASA base and more on the fee-based revenue, because I think I elaborated more on that earlier. When the balance sheet is not growing, how we will improve on our margins and concentrating on fee-based income and other revenue bases, whilst of course managing the cost side. There's a question on stage 1 has taken a write back, whereas stage 2, 3 impairment increase Q and quarter on quarter. What is the reason for taking movements? So when do you want to take that?
Yeah, so I think we reviewed our stage 1 portfolio, and as you see, in line with the industry, there's a risk element in terms of asset quality. So certain facilities being conservatively, proactively downgraded, where we felt that we need to buffer up our impairment provision. So that's the reason why stage 2 level and 3 level, we have increased the impairment provisions. So these will not be actually real losses, but we have accounted for any expected credit loss that we see currently.
That's another one. Tier 1 capital increased by around 3 billion. What drives this growth?
Yeah. What has really driven the profitability. So we reported 2.3 billion profit after tax. So that has been capitalized. And also we hold a yields and bonds portfolio, particularly on our bond portfolio, and with the interest rate movements, we have a fair value gain. So all that has been certified by EY, and we have capitalized it to profitable tier 1 capital.
There's a question about how has the T-bills and bond mix changed from 2022 levels, and how many bonds and bills bank is holding now. Of course, the mix has remained same. There's no change to that. Since these bonds are at relatively high rates, I think there can be some capital gains going forward as the rates have come down. There's a question on what's the breakdown in between fixed and variable loans. Expectation of loan growth for coming quarters. So fixed and variable, I think that's something we have been working on, reducing our fixed rate exposure, and whatever the new loan that we are growing, it would be mostly on variable loans. And loan growth for coming quarters, we are not having high targets. The demand is gradually picking up, but it would be more cautious approach in terms of loan growth, and we would be naturally look at the total returns, the RORAC, that as I mentioned, when we book additional assets. So it would be a cautious growth. There's a question about, has loan demand picked up in recent weeks? Have we done any import financing for vehicles? Loan demand is coming up. It's improving. We have not done any import financing for vehicles, as I said, but on the import side, other imports, commodities, all that we have been supporting. So that is how our fee-based income has improved. There's a question on what's your ISP provision figure. Of course, the provisions are in line with the industry. And as I mentioned, that we had a half-yearly profit review and profit certification also by external auditors. What's the outlook of the asset quality review? Of course, we are not privy to that information. Okay, there's a question, have you been hiring in the recent month? We see that other banks are expanding their workforce. I think the hiring, of course, we also continue to hire because of the economic situation and all, we had seen staff turnover, mostly going for overseas opportunities. And as a result, that creates vacuum, and then all the banks have started advertising, which is an industry-wide situation that we have seen, and we are also have seen staff turnover, so naturally we'll be hiring. There's a question, will there be further provision reversals on ISP once the external restructuring is announced? Yes, I think what we have made provisions are based on what the government has indicated as potential haircuts, etc. But that's an initial proposal from the government. I think when it comes to final negotiations with the separate, especially the external ISP holders, there can be changes. So based on that, either additional provisions or reversals would be based on that. What's the status of credit card delinquency over the past quarter and recent months? Sanjay, want to comment on that? Credit cards, I think one area is our credit card portfolio is much better. So we have been catering to the upper end of the card, but of course people had challenges in terms of income, especially the tax increases and all. So it's slightly increased the delinquency level, but that is managed. We have seen the flow rates reducing. When I say flow rates from one bucket to the other bucket, that flow rates have been reducing, and we have been improving in terms of our collection staff also to support that. So gradually, yes, it went up in the first half, especially the first quarter with the tax impact, etc. But now it's gradually coming to a level that is manageable. Understood. Hotel and tourism sector loan exposure, I don't think there's an increase, 7%.
Because of the dollar exposure.
Yeah, I think that's mainly the exchange impact, because we are not increased our exposure. And what is the plan from capital raising? So as I mentioned, tier 2 level, certainly we have announced what the plan is. So during this year to raise debentures and make use of the current low interest rate opportunity to raise it. Then in terms of the tier 1 level, once the economic situation is stabilized and we are clear even on the ISP side, what is the impact, etc. Most likely next year, second half onwards, there will be some equity raising plans that the bank is looking at. What sort of dividend policy bank is intending? I think that's up to the board also to decide. But we have been having a dividend policy of about 25 to 30% of profits. But how you pay that, whether cash or scrip dividend, is something that the board has to decide. That's a question on in what sector is the loan demand coming for the reported quarter, and also in terms of geography, provinces. Sanjay, anything to comment here?
Especially on the leasing side, there is a little bit of demand with interest rates coming down, and also on the housing side, those are the sectors that are being improved based on the rates.
That's a question on is the stock brokerage or the business operating at a profit in both the reported and that's one of the subsidiaries, I think, and in line with the market improvements, our stock brokerage arm is doing quite well. These are the questions we have received so far. If there's any questions, please feel free to raise. Otherwise, in the absence of any other questions, we thank all those who took part in our investor webinar. Thank you so much for being with us, and thank you for banking, investing in us, and looking forward to a similar quarterly update once our third quarter numbers are finalized. So thank you so much for your participation. With that, we conclude our investor webinar. What is the question? So there's a question, sorry, last or ISP provisions. So I think it's around 35% and above.
Slightly above.
Slightly above 35%.
So actually, we have done our computations based on the indications given by the DDO proposals as well. And based on our portfolio, we are maintaining 35% and above, slightly above 35%, which is quite adequate. based on the direction that has been given.
That's a question whether they had a 5% reversal, not really, no.
Not really, yeah. So 30% haircut, and we need to have, I mean, there will be a day one impact for all banks. So we have computed the impact also based on our portfolio and the price at which we have purchased and the time maturities. So based on that, we are quite confident that based on the directions, indications that we have given, the provision that we carry is adequate.
Okay, those are the questions. So thank you so much again, and we will conclude our investor webinar. Thank you for your participation.